So the first one is, do you still think Bitcoin is not a good investment? It's been my best performing asset, bought in 2020. Average cost $25,000, though it's just a small part of my portfolio. Love this question.
It's a good question.
So has Bitcoin been a good investment, as this person describes it has been for them? With the benefit of hindsight, absolutely. I mean, if I could go back in time, I would also buy Bitcoin. Is it a good investment ex ante or looking toward the future? I think that's a lot harder to say. Now, I've been wrong about that in the past. I mean, I didn't buy Bitcoin 10 years ago or whenever I could have. Some people did. Some people have held on since then. I don't think very many have, but some have. But just because the number's gone up in the past, just because Bitcoin's had good returns in the past, that alone does not give me much conviction that I should be buying Bitcoin now. Fama was on a podcast recently, and he went way further than I just did. He said that Bitcoin will likely be worthless within a decade. Now, he did also hedge a little bit. He said that the distribution of that prediction has very long tails, so Bitcoin could stick around longer. I don't know if I'd say that. Like, I don't think it's going to disappear. I think, as we've talked about a few times in the podcast in the past, Bitcoin's kind of like it's a representation of a way to think about the world. It's a representation of sort of libertarian ideals. And that's really built in the software. That's kind of what it was coded to do. And when you read the white paper, that's pretty explicit. I don't think Bitcoin's actually a good representation of that anymore. It's centralized in a lot of ways faster than like any technology ever. But I do think it still offers some form of sort of expression. And so I don't know if it's going to disappear. That doesn't make it a good investment though, looking forward. And then the other thing I would say is, like, why are we even talking about Bitcoin? That is so 2021. NVIDIA has performed way better. Like, why is this still coming up?
We should just be all in on NVIDIA. Forget about this Bitcoin. Yeah. So, Ben, I have a question for you because I always think this is an interesting way of looking at it. For a long time, my approach to Bitcoin was that technology is interesting and will almost certainly have some impact on our lives going forward, the blockchain technology being. But I can recall it was a few episodes back, this came up in discussion and you had kind of said, nobody thinks that anymore. It's basically a glorified Excel spreadsheet or to something to that extent. And I'm just interested in hearing you elaborate on that a little bit more because I respect what you know about this stuff.
I mean, listen, I'm not an expert on databases or on software technologies, but people who are that I've spoken with, including in the first episode of our exploring or understanding crypto series that we did, people who are experts in databases are not they're not too excited about blockchain. I think that there's a phrase for a while, people who are blockchain but not Bitcoin or something, and I think Bitcoiners would make fun of those people. But I don't think that blockchain itself is a very interesting technology. It is a database, as I understand it. I've got a good friend actually who is a data engineer. And we talk about this often, different from the person who was on our podcast. And he agrees, like, there's nothing interesting there. And when you look at the way that the actual innovation, the innovation within Bitcoin is combining the token incentive with the database. And I think that makes it a pretty useless technology for most applications. So I think that and I think it's died down, right? Like, there was a time where hype around blockchain was everywhere, and I've not heard about it other than you bring it up just now for a very long time.
No, it definitely seems like an old idea, and that's why I was just kind of interested in kind of updating that thought. But I guess the message here, I mean, like with so many different technologies, AI being, a more recent example, sometimes just the best way to get exposure to that technology, own a total market index fund. And then no matter what companies benefit from that technology, for sure you have them in your portfolio. Now, you're not going to outperform the market that way, but you are going to make sure that you didn't miss the boat because so often these technologies evolve in ways that we were not expecting, like this thing called the internet.
Yeah.
I'm just go back
but
to
You're right, though, because if it's such a revolutionary technology, then it will benefit all companies.
Mm-hmm.
and the stock market will go up as it does due to innovation. Betting on innovation of any kind is historically a pretty bad bet. This question wasn't necessarily about the innovation aspect of Bitcoin, I don't think. And I think Bitcoin has come to represent something else. I don't think people buy it anymore because they think it's innovative. I think the notion of Bitcoin replacing the financial system has died down a lot.
I don't know, man. I don't think so. I spend a lot of time like on Bitcoin Twitter, and I think that side of the argument, and maybe I'm just living in the echo chamber of Bitcoin Twitter, but that side of the argument, like the maxis, the Bitcoin maxis are fierce in their approach to this. Like if you think about Bitcoin belief on a spectrum, like Ben, I agree with what you're saying. It's a representation of some kind of ideological system. And those who really fully believe that that's the future and that what we've been doing is wrong historically, Bitcoin is their sort of solution to that. And if you listen to them, they've put like their entire net worth into it, and it is destined to go to infinity. And they're not backing down from that. And their conviction, I think, has even been redoubled in that sense. And then you've got people who are just like, the number goes up, I just want to make sure that I'm getting rich if Bitcoin goes up, right? And so I think it depends kind of where you are on that spectrum as to whether or not you want to include it. But like there's a lot of people, I mean, look at like Saylor and Micro, or now they've renamed themselves to Strategy, I think, instead of MicroStrategy. But like he's got a ton of fans, and like his bull case for Bitcoin is, I think, 43 million per coin by 2030 or something, like absolutely absurd. But he has a massive audience of people who are like, think about it the same way he does. So like, I don't know. I'm not a maxi when it comes to Bitcoin. I do own a little bit. It's not a recommendation, but my whole thing is, what if I'm just wrong about all of this and Bitcoin is the future and I just didn't expose myself to it properly? But I agree with what you're saying, Dan. Like if it's successful, then Bitcoin shows up on the balance sheets of companies, and it already does, like MicroStrategy and Tesla, and these companies are going to transact in Bitcoin or accept Bitcoin. Like you're going to participate in the growth of the technology sort of organically. So I'm kind of mixed, and I own a little bit just as a hedge against myself being wrong about the whole thing.
You own some pretty ridiculous stuff though, so I don't know.
Sure. My son is a gambler. He's 6, and he owns MicroStrategy and all this other crazy stuff. I can't believe it.
I think El Salvador
shut
down their
the Qs.
Yeah, like the TQQQ. That's what I was thinking about when I said you own some ridiculous stuff.
Yeah. But I, like my portfolio, my core long-term portfolio doesn't own that stuff. I started a small account for my son, and we put some just absurd things in there, and it's small
irresponsible
now. He's a degenerate gambler. He's 6. I can't believe it. I don't know where he gets it from.
El Salvador had tried to make Bitcoin legal tender, and they've shut that down since. Like I don't know, man.
It's kind of like half and half, isn't it? I was reading something yesterday that was trying to answer the question, have they shut it down? And it's kind of like yes and no. Like it's not, I don't know if it's as promoted as it once was, but people do still use it. But yeah,
I think the law making it legal tender is what changed. And I think the adoption has been super low in El Salvador, despite that law anyway. Yeah. Did I have other thoughts on Bitcoin? Maybe not. All right, move on. Next question, they're asking if we have a clips channel. I asked Angelica about that. We had a YouTube channel, like a shorts channel for a while, but I guess we stopped posting on it because it wasn't getting much traction. We do post clips on Instagram, which apparently get more interaction. So there are short clips of Roush Reminder content on Instagram.
And TikTok. I see it on TikTok all the time. It's super weird because I'm scrolling TikTok and my face comes up sometimes. I was like, what? Like, what is that? Because TikTok's algorithm just feeds you stuff, right?
That's funny.
And then we do post the videos on LinkedIn and Twitter, the shorts as well. I usually see them there. I'm not on Instagram. Well, I am, but I just don't really understand Instagram, so I don't see them there.
Why don't more companies direct list on the TSX, like Apple and NVIDIA? CDR fees. CDRs are Canadian Depository Receipts, so you can invest in a foreign stock on the Canadian market, but they do have high fees. I mean, the amount of capital flying around in Canada is relatively small for like a company like NVIDIA or Apple. There's probably listing fees and stuff like that are not super necessary for a company that size to pay. They're not hurting for Canadian capital. And I also think it's pretty easy for a Canadian, I mean, you have to pay foreign exchange fees, but it's pretty easy for a Canadian to go and buy a US stock from a Canadian brokerage account. So I'm not surprised that a lot of companies are not listing in Canada.
Or even through ETFs, right? Like even through Canadian domiciled ETFs, you've got a ton of access to these stocks and US stocks. But Ben, you didn't even finish the question. The question ended with "Love the content. Y'all are goated." That was like by far the best part of the question. So thanks whoever wrote that.
Yeah, I don't copy the names down when I paste the questions over. When you read the questions one time, Mark, you were saying the name every time, and I'm sure people loved hearing their name. And I need
Next
to be
time.
more like you.
Maybe we can do that. Yeah, you know.
I'll try harder next time. We'll have more opportunities in our future AMA episodes.
There you go. Still learning.
Someone asked for the workout routine. I was working out a lot before I had to get my testicle removed. I kind of chilled out after that. Although I did play basketball on Sunday, which was much sooner than I think the surgeon thought I would, but not thought I should. He said 4 weeks, and I was like, really, 4 weeks? You sure? He's like, technically after 2 weeks you could probably play and not get hurt, but I wouldn't recommend it anyway. I played after 2 weeks. But I gained a bunch of weight working out before the testicle situation. But I kind of haven't got back into it because when we're recording, I won't find out until next Tuesday. So by the time this comes out, I will have gotten my diagnosis, but I haven't got back into working out because I don't know if it's going to get thrown off track again by future treatments.
But what are you doing? You're weightlifting, right?
Yeah, I was doing a ton of weights. I was using an app called Caliber, which has a pretty good, it generates workouts. I don't know. So I was doing that and eating a lot. Gained 15 pounds of muscle, which I've since lost.
What's the diet? Carnivore diet, right?
No, I mean, I eat a lot of meat, but not only meat. I eat a pretty balanced diet. That's the carnivore diet, right? Only meat?
I think it's meat only. Yeah. I know you eat a ton of meat. Yeah.
That's not
one of these days you're going to have to post a picture of that this awful quesadilla that you made one time. That my wife's Mexican, right? So I've been eating Mexican food at home for 15 years, and you posted that picture somewhere, on our internal channel or something, and I was like, I can't show my wife this. I can't let her know that Ben has disgraced her entire culture with this quesadilla. It's terrible.
That was like a random late night snack. I mean, I don't know. I put some cheese on a tortilla and microwaved it. What's wrong with that?
Yeah, you don't microwave it, man. Stovetop. Come on, no shortcuts.
It's a quick snack.
Jeez, does anybody think they might have tuned into the wrong podcast?
Yeah, maybe. No, you're in the right place.
Yep.
I used Caliber as well, actually. I was lifting weights somewhat regularly before the holidays, and I just haven't gotten back into it. Caliber's great. I didn't have the pro version of it, but I think it's a great app. Yeah, you can generate tons of workouts, but you can also just customize your own workout. So I was using that, which is great. And I know I wasn't asked this question, but I've had a treadmill, under the desk treadmill for a while, and it was kind of just sitting in the closet, and I've got a sit stand desk that's automated. It's electric, I guess. And since January 6th, I got back from Mexico for the holidays, January 6th. I haven't sat down to work since January 6th. I've been standing the whole time or walking. If I'm answering emails, writing, researching, reading, all that kind of stuff, as long as I'm not in a meeting like this or with clients, I've been walking, and I've been cranking out 12 to 17,000 steps per day. And I was just telling some friends, I was like, actually I posted on Twitter. I was like, my gut, my belly is just, the fat's just dropping off. This is crazy. And I haven't changed anything else. Haven't changed my diet or anything like that. But I hadn't weighed myself, and I weighed myself this morning actually. And I'm down 5 kilograms in basically 6 weeks, which is more than I probably should. I think a healthy amount is something at the most 1 kilo a week. And I'm kind of, I guess I'm about on track for that. But yeah, it's great. For anybody who's a desk worker, if you can, it was $250 from Amazon, just cranking out steps all day long. And yeah, it works. It's great.
Good for you. That's awesome.
Yeah.
I have the opposite thing. If I stop working out, I lose weight. I have to work out to gain weight.
Yeah, but you're 9 feet tall. Your resting metabolic rate's probably 17,000 calories a day.
That's probably true.
Yeah.
Okay, back to investing questions. A little bit of a tangent there, I guess. What is the optimal way to make factor investing? I think they mean implement factor investing, where ETFs related to factors are not available. So if you're in a market where you don't have factor ETFs and you want to do factor tilting, what's the best way to do it? I would probably just not do it. If you're going to go and pick individual stocks to try and build your factor tilt in, I don't know. We're talking about, I looked at PWL's updated expected returns for one of the questions, I think, later in the AMA. And our expected return difference, which is it's not a shot in the dark. That's not fair to say because we put a lot of thought into it, but we expect about 40 basis points of additional expected return for a factor tilted ETF or portfolio. So, I mean, it makes a bit of a difference, but it's, nothing too crazy. And if you don't have the proper tools to implement it, I think it can get pretty messy pretty quickly. One thing I will say though is that there are some, and I'm not saying I would actually do this, but just worth considering, there are products that might have a naive factor tilt, like they're not designed specifically to target the Fama French factors or whatever. But for example, a dividend ETF or like a dividend growth ETF or dividend aristocrats or whatever might have value and profitability exposure as one example. Now it has trade-offs because when you're using a dividend screen, you're getting a big reduction in diversification because, roughly half of global stocks pay dividends and half don't. And you've also got issues with tax inefficiency in a taxable account or in a non-taxable account if it's a foreign dividends. So I don't know, I would just be very cautious, I guess.
Mm-hmm. This question probably came from somebody that's not resident in Canada, I'm presuming, but Canada does have some ETFs by Manulife, and I'm just curious what you think about those, Ben. They're the Manulife multi-factor ETFs, I think they're called, and they're sub-advised by Dimensional Fund Advisors. The fees are higher than Dimensional funds, but a lot of people can't access Dimensional funds in Canada without an advisor. I'm just curious if you've looked at those ETFs.
Yeah, I actually have some notes on them specifically because somebody asked a question like this about Canada specifically later in the AMA. So I can come back to those notes later maybe. But yeah, I'm aware of them. They are sub-advised by Dimensional. I think the factor tilts are a little bit lighter than the Dimensional funds that we use, and the fees are a little bit higher. I looked at them years ago and was kind of so-so on them. But yeah, I mean, in a pinch, I guess they're kind of doing it. But yeah, the fees are a bit high. Although I think they have come down since the last time I looked at them.
Nice. Yeah, the last thing I'll say is I know U.S. markets are available to a lot of investors. I've got a family member, my wife's family member, I think in Mexico, that uses IBKR, Interactive Brokers, but opened like a non-domiciled Mexican account, like an international account of some kind, and buys the U.S. ETFs. Because that's just not a common thing in Mexico, is to open like a brokerage account and buy stocks or ETFs. So they were able to access U.S. listed ETFs. So there are like Avantis and DFA ETFs available in the U.S. markets that you might be able to access as an international resident. I don't know a lot about that, but might be worth looking into.
Yep.
Yeah,
I mean, I think just generally speaking, I wouldn't get too hung up on factor tilting. If the products aren't there, if you've got to pay really high fees or high foreign exchange costs or whatever to do that, I'd be pretty quick to just say, don't do it, rather than trying to do a bunch of gymnastics to build in a factor tilt.
Mm-hmm.
It does raise a really interesting point, right, about how you define the certain factors, right? I mean, there's lots of different ways to do it. Something like small cap is a bit easier and more consistent, but I mean, value is a great example. And certainly for ETF investors, if you scan the, ETF availability for things that call themselves value funds and look at the various providers and then look at the methodologies, they're completely different. And it's not at all unusual if you were to buy or even to look at, say, 3 different Canadian equity value ETFs, the dispersion from year to year on those is enormous. So you have no idea what you're buying unless you really drill into the methodology. So, if you're interested in value investing, better make sure you know how to define it. And I think, that's probably where Dimensional excels, in that they know exactly what that problem is and they know how to target the research-based factors much better than most other fund providers would. Well, probably better than all of the other fund providers.
No, that's such a good point. I read, I don't think it was an academic paper. I think it was a post somewhere, but it was talking about what you just said, Dan, the dispersion in value returns and value portfolio construction. And if I remember correctly, a few of the value portfolios that were being looked at, I think they were ETFs or maybe they were indexes, I can't remember. But a few of them they looked more like growth funds if you define value kind of the way that Dimensional does. So like to your point, you have to be really careful about what are you trying to get exposure to, and does the name of the fund actually indicate what it's delivering? Because value can mean a lot of different things to different people.
Yeah, it's not a trademark term. There's no technical definition of it. I mean, I think we all have an understanding of what we think it means, but you're right. It's nothing to stop any fund company from putting that label on a fund to make it sound attractive. And it might have very little exposure to what Dimensional would define as the value factor, or, what some academic might describe it as. So.
And the fund company probably believes it is that. Like I remember, I think Kathy Wood has said something along the lines of she's a value investor, which when you look at the relative prices of the stocks in her portfolio, like they're not value stocks, but she thinks that they're undervalued relative to their future cash flows. So she's a value investor. So it's like,
yeah, everyone's a value investor. If you think about it that way, like literally that's the entire point of it.
Yeah. All right. Next one. If you could only pick one ETF to invest in for 30 years, and that is when you retire after 30 years, would you go for market cap weighted, total market like VT, so total international stock market, a mix of equity and bonds like a 60-40 portfolio, or a heavy factor tilt like a small cap value portfolio? I would do something like DFA 607, which is what I actually do, which is total market with a Canadian home bias, with some moderate factor tilts. If I can't pick DFA 607, as many people can't, I can buy that because I work at PWL. If I was precluded from buying that and had to stick with the list here, I would go VT. If I can go past this list, I would do one of the all equity asset allocation ETFs from the big ETF issuers in Canada, like XEQT or VEQT or ZEQT. I don't know what other letters there are now.
Yeah, I think HEQT. I know TD has some ETFs as well. I don't think they have a full equity portfolio though. I think T-Grow is as aggressive as they get with it. But I'm the same. XEQT and chill is like pretty much my motto at this point. I'm thinking about getting T-shirts made. Like I just think it's just such an elegant solution for portfolio management that it's difficult. To your point, like I use DFA 607 for my own personal portfolio, but most people can't access it. And I think, risk tolerance and profile allowing something like XEQT. If you're at the point of choosing like VEQT, ZEQT, or XEQT, like whatever, pick one. But I've always been a fan of XEQT, and that hasn't changed.
I'm kind of surprised that this is phrased or framed as a product question, because it's basically the question is, what should your asset allocation be if you have 30 years to retirement? The product is really secondary here, right? Like the two choices that the listeners offered, basically 100% equities or 60-40. Well, how can you answer that question unless you know the individual's risk tolerance, right? I mean, over 30 years, the chances of the 100% equity outperforming, I don't know, 99.9%. We can all agree on that. The question is, are you going to be able to stick to that for 30 years? So, I mean, to me, this is a question just simply, what is an appropriate asset mix for your time frame? And then question number two, what product should you use to implement that strategy? And at that point, as you said, whether you're picking the Vanguard or iShares or BMO version of whatever asset allocation fund doesn't make a huge difference.
Yeah, great point.
But I always try to steer people away from the what should I buy question, as opposed to what strategy should I use to invest, which is so much more important.
Oh yeah. I actually posted a screenshot from my book, and it's basically the iShares, Vanguard, and BMO all-in-one ETFs, their costs and their asset mix or whatever. I tweeted out yesterday just to see what I said something like pick your fighter, and like most people it was like VEQT or XEQT, but a lot of people were like, oh, what about Bitcoin? What about QQQ? And I'm like, no. Like, no. That wasn't the question, right? But to your point, like once you nail down the strategy, the point of putting that in the book was like, these are very, very equivalent costs, asset mixes. They're essentially the same product. So once you align with the overarching strategy, then again, outside of the risk tolerance question and how much fixed income you want to have, it's not really a big deal which one you pick.
Yep.
Next question.
Yeah. You want me to read it, Ben? You've been reading all of them.
Please do.
Okay. Yeah, I'll read it because you're going to answer this one. So, what are your thoughts on using buffered ETFs for clients who have less risk capability but still need to take more equity, I guess, than they would have if it was just a normal stock or bond split? What are your thoughts in general on buffered ETFs versus buffered annuities? Thanks and love the podcast. Do you want to explain buffered ETFs first?
Yeah, they're called buffered ETFs or defined outcome ETFs. They're kind of like structured products in an ETF format. So they have downside protection, but you're capped on the upside. I don't know what a buffered annuity is, and I did not look it up. I don't know if we have those in Canada. It sounds like a US product
Yeah,
because they
probably.
got more variable annuities there. We don't really have those here. I don't love assets with this type of payoff. Like they're using options to cap the upside and protect the downside. I don't think they fit very well with the realities of the distribution of stock returns. I think people are behaviorally super worried about downside risk, which is fine, and like you have to take that into account. But stock returns are more often positive than negative, and there are big up days that explain a huge portion of returns. If you miss those best days, your returns can drop very, very quickly, and you don't really capture the long-term returns that stocks have to offer. Buffering on the downside helps a little bit because those really bad days hurt too, but I don't think the overall trade-off on both sides combined makes a whole lot of sense. So it's just not obvious to me that this is a really good way to increase your expected returns relative to a balanced portfolio if that's the objective. I've seen the argument that more for structured products, but I think it applies here too, that in some cases, this is the only way to get someone to have any exposure at all whatsoever to the stock market. Like the alternatives to stay in cash. And like, if you're really going to twist my arm there, sure, I guess. I looked at some of the returns of buffered ETFs that are tracking like US stocks, for example, and the returns have been much higher than cash. They're still more volatile than cash. But if someone came to me and said, I'm either going to invest in cash for the next 50 years or this buffered ETF because I'm so scared of downside volatility, I mean, fine, I guess. I wouldn't use them personally, and I wouldn't use them for client accounts. But yeah, that's the only way I could see them making sense. What do you guys think?
Yeah, similar. I mean, where's the free lunch there, right? I guess is always the question. Like, you want equity-like returns and bond-like volatility. Like, yeah, don't we all, right? And
Me
so
too.
you overlay some expensive option strategies in there, and options markets are pretty darn efficient and mathematical. Like, you're just paying additional fees for a balanced portfolio profile, probably, if you were to track some of these. Like, I'm sure you could find an equity fixed income mix that tracks and correlates very highly with a lot of these ETFs. I haven't taken a good look at them. Like, I've had clients ask about them years ago and took a look at them, but I'm generally in agreement with you, Ben. I'm not a fan.
Yeah, you obviously have to be very suspicious of anything that promises upside without corresponding downside. But I think, Ben, you make a good point. Like people have asked me not so much about buffered ETFs, but about like market linked GICs, these ideas that you get a little bit of the upside if the market goes up and you don't lose anything if the market goes down. Of course, you get only a small fraction of the upside and none of the downside. But as you said, if you're just the type of person who could not possibly bring yourself to invest in equities and you can tolerate zero loss, it's better than nothing, I suppose. But that's not really high praise, is it?
No, and those things have like market linked GICs. I think the floor is usually zero. I haven't taken a lot of a look at those, right? But you're trading off something like a guaranteed fixed income return through something like a GIC for the potential for 0 or 10%, right? So there's still, and these are nominal returns, so there's still inflation risk over that horizon. So yeah, I mean, I think that's a trade-off that people would have to consider. And it's not obvious to me that buying something like a market linked GIC, which could have a return of 0 over 5 years, is necessarily better than just getting a fixed income payout of 3 to 4%, depending on what rates are doing.
Yep. I haven't looked super closely into how the mechanics of the buffered ETFs, but I know in the market linked GICs and the principal protected notes and all that kind of stuff, they're typically linked to price only index returns. So that's another kind of cost where the bank hedges their exposure using total return, and they keep the dividends, and you don't get any piece of that.
And it's taxed as interest usually with a lot of these structured products, is it not?
Yeah, I think so. There was a legislative change around that a while ago. I don't know. We don't use them at all. So
yeah.
Next one.
Sure. Dan, you want to read it?
Yeah. Think this is a good question. How should we think about market efficiency and expected returns when investing in markets with low transparency and or high corruption? China, some emerging markets, etc. Is there an efficient way to tilt the international portion of a portfolio away from these risks? So my first reaction is this. I mean, I think this is a good question, and it is certainly one that I have heard from clients expressed slightly differently. We normally include the entire global stock market in our portfolios, which includes an allocation to emerging markets. We've had some clients say, I'm not comfortable investing in emerging markets in general, sometimes mentioning specific countries that have a reputation for corruption and low transparency. And, the efficient market part of me wants to say, well, those risks are already priced in and the expected return is higher if the expected risk is also higher, et cetera, et cetera. And that all may very well be true. But in practice, if a client says to me, I don't want to include emerging markets in my portfolio, I just want to include Canada, the US, and international developed countries, I'm not going to argue with them. I think it's a perfectly legitimate position to take. Again, is it optimal? I don't know, but you need to invest according to your values, I think, too. And if it just makes you uncomfortable, whatever potential benefit there might be from including emerging markets is going to be outweighed by your discomfort and your resistance to it. So it's a question that I think it's okay to not invest in that asset class if you feel the trade-off is not worthwhile.
Well, in emerging markets is usually relative. I mean, by definition, is going to be a low percentage position in the portfolio just based on its relatively small market cap anyway, right? So it's not like you're saying I don't want to invest in the US, which is 2/3 of the global market. It's like, okay, well, now there's a much bigger trade-off there. And if those are your values, then yes, you have to make that trade-off. But if it's like a 6% of the portfolio that you want to allocate to developed markets instead, I agree. Like long term, it's not likely to be the biggest difference maker.
Yep. I've had that conversation with clients on both sides that you've had, Dan, where in some cases I've had clients wanting to allocate more to countries like China because they see that it's got high expected growth and that it's maybe a bit riskier, so they expect higher returns, which in the case of China has not really been the case. That was a bit of a flop, I think, relative to what a lot of people expected. And then likewise in the other direction, where people just don't want to invest in these markets. And I agree with you. It's not something that's not a hill that I would die on. I think if someone said I don't want any international developed markets, I think that's, I only want to be US. It's still probably not the end of the world, but it's, I'd put more of a fight up on that one than I would on emerging markets. The distribution of returns for emerging markets is also kind of weird. Like we did an episode on this and I did a video on it a while ago. And I said that it kind of looks like a reverse lottery where they've got theoretically higher expected returns because they're riskier. And historically, they've had periods of really high returns. But if you hold on to them for a really long time, they have these periods of extreme catastrophic losses from time to time. So I call it a reverse lottery because it's like you can win most of the time, but occasionally you might lose really, really big.
It's Russian roulette.
Yeah, kind of like that. Dimensional does think about this. I wanted to mention that before investing in a market, particularly in an emerging market, they look at the costs and frictions associated with investing there. So they'll look at like the market liquidity, they'll look at market regulation, accounting standards, listing requirements, stuff like that. And if there are any red flags, they will underweight or potentially exclude an emerging market. So I remember when the Russian stock market effectively went to zero for foreign investors. I think Dimensional's weight was like half of the market weight of Russian stocks because they had concerns about property rights in that country previously. And that's not like, it wasn't an active bet. It was like, these are our criteria for investing in emerging markets, and this country is not fitting that criteria right now, so we're going to reduce the weight. Still a tiny weight of the overall portfolio, so it's not like it made a huge difference, but it is interesting.
Okay, I'll read the next one, Ben, because you're going to talk for the next 4 hours on this question. Pensions and other institutions use portable alpha, now being rebranded as return stacking. If the stacking is done with low risk assets one would already have, like a global market index and treasuries, can this be a good idea for an individual?
Yep. Return stacking has been like the greatest recent marketing success in the ETF industry. It comes up a lot. Been getting a lot of questions about it. These are products that give you leveraged exposure to multiple sources of expected return. So you invest $1 in a fund, and it gives you $1 of exposure to stocks and $1 of exposure to treasury bills, for example. That's one way to set it up. There are other ones too, like more exotic sources of expected return that are stacked in some of these products. But it's giving you a bunch of leverage, and it's giving you something that in theory could make sense. I think people love the idea of using leverage. Like we did an episode on leverage years ago, and so many people, like clients, were like, okay, I want to use leverage now. It's like, whoa, wait, that wasn't what we were trying to do. I think it's because it's like, Robert Merton talked about this too. Like in theory, it makes sense to use leverage when you're young, but I don't know if that's practically always super sensible. But anyway, theoretically, levering up the maximum Sharpe ratio portfolio to your desired level of expected return is superior than concentrating in higher expected return assets. So in theory, you're better off levering up a stock and bond portfolio, assuming it's got a higher Sharpe ratio than an all stock portfolio, to get a higher expected return than you are going all into stocks to increase your expected returns. And that's based on the assumptions in the capital asset pricing model. So I think people get excited about that kind of theoretical optimality thing. There was a good discussion in the Roushaminder community on this after our last episode, or 2 episodes ago, episode 343 on asset allocation. Someone asked about this in there, and I answered their question. And then Corey Hofstein, who makes return stacking products, he joined the community and joined the discussion. And then Scott Cederberg was in there too, who's done research that's pretty relevant to this. It was pretty cool. I mean, Corey and Scott are both people that I respect. So it was neat to see them going back and forth about this. It was neat that I was able to participate in that. So I had said, to answer someone's question, that Scott Cederberg's paper, the most recent version of it, showed that even in the lowest cost of leverage scenario, so Scott looks at like basically what's the optimal portfolio over someone's life cycle. And in the most recent version of the paper, they allow leverage to see if that changes the optimal asset allocation. And so in there, they find that in the lowest cost of leverage scenario, they test a few different ones, and with a 100% leverage limit, the optimal portfolio did have a small bond allocation. Not huge. I think it was like 15%. So that was my response. Like even in this kind of like really low cost leverage case where you've got a huge leverage allowance, only a bit of bonds make sense in the portfolio. And then Corey jumped in and explained that in his view, Scott's study used a cost of leverage that was too high. And he also said that the maximum drawdown in Scott's optimal portfolio was 96%. And Corey's saying that's ridiculous. Nobody would invest in that portfolio. And so Scott, in the course of this discussion, mentions that drawdown occurs in the simulations with a probability of 0.003%. So it's pretty unlikely. And then the other thing that was interesting is that Corey disagreed with Scott's use of utility of consumption and bequest, which is how they measure the different outcomes in their paper. Because one of the things they look at is comparing their results to a 1996 paper that Cliff Asness had done on why you should not invest in a 100% equity portfolio. And so in Cliff's paper, he had used the Sharpe ratio based on annualized monthly standard deviations to show that the levered 60-40 portfolio is superior to a 100% stock portfolio, which again, in like basic CAPM theory, that's kind of what you'd expect. And so Corey's saying, well, Scott used utility to disagree with Cliff, who'd used Sharpe ratios. So those two things aren't comparable. And so, I mean, that alone is an interesting discussion point. Like, should we use Sharpe ratios for long-term portfolios, or should we use utility of consumption? Which thing matters more? I think that the way that Scott set it up probably makes more sense, because Sharpe ratios kind of fall apart at long horizons for a couple of reasons. Long-term returns are skewed, as we'll hear about next week with Hendrik Bessembinder. I wasn't sure if that was last week or next week, but we talk a lot about that. Long-term returns are skewed. And then the other thing that Scott's paper captures with their block bootstraps is that there's autocorrelation in returns. So returns from yesterday are related to returns tomorrow. And the CAPM kind of assumes that returns are IID, independent and identically distributed. So the Sharpe ratio is just not designed for the realities of long-term returns. It's really a single period model, and it has some assumptions that I think real returns, actual return distributions violate. And then the way Scott measured it with utility functions, they kind of acknowledge that stuff and capture it. Now, I do also want to say that Cliff acknowledges this in his 1996 paper. He says, if stock and bond returns are independent from period to period, and investors are risk averse with constant relative risk aversion, then a longer horizon changes nothing. The relative weight of stocks and bonds would be constant across otherwise similar investors with different horizons. The solution changes only if the volatility of stocks increase more slowly with time than does the volatility of bonds. And then continuing the quote, there is some evidence that stock returns do in fact exhibit negative long-run autocorrelation, and thus volatility does go up more slowly than if returns were independent. Many have challenged the existence of this negative autocorrelation, but if it does exist, it could lead to stocks being a larger part of optimal long horizon portfolios. So Cliff acknowledged this in his 1996 paper that a lot of people use to disagree with Scott's paper. Like, no, look, Cliff showed this, but I don't know if he did. And he acknowledges where his results would not be the same as what he presents in the paper. And Scott's paper, on the other hand, is specifically designed to address that comment that I just read from Cliff, that Cliff acknowledged would change results. Scott's paper even does report on variance ratios, showing that the volatility of stocks increases more slowly with time than the volatility of bonds, which is what Cliff said would change his results. On the cost of leverage, this is another interesting point. So Corey had said that Scott's assumptions were too high. Scott had leverage spreads over Treasury bills from 0.37% to 6.5%. Both of those numbers are based on academic research, like other papers, looking at what is the cost of leverage. The optimal levered portfolio with the lowest cost of leverage and the 100% leverage limit that I mentioned earlier did have a small allocation to bonds, but then with higher costs of leverage up to 50 or up to a 55% cap on leverage, bonds did not have a place in the optimal portfolio. Hopefully people are following this discussion. Like, the question is, should you be stacking stocks and bonds in a portfolio using leverage? And Scott's research is showing no, probably not. That's kind of what this discussion is about. So what is the cost of leverage? I think is a really interesting and important question, because as Scott's research showed, with higher costs of leverage, bonds don't get a place in the optimal portfolio. Funds using Treasury futures, which a lot of the return stacking products use, do have very low implied financing rates through futures, pretty close to the risk-free rate. And so that 0.37% is, I think, a pretty fair assumption for that case. But then the other interesting question, I think, is whether the fee in a product using leverage also needs to be included in the cost of leverage. Because products using leverage, like an ETF that is internally using leverage, are going to tend to have higher fees than the cost of investing in the underlying assets on their own. So if you take a hypothetical fund that for every $1 of investment invests $1 in stocks and $1 in treasuries, and it's got a financing rate of the, say, 0.37% that over T-bills we've been talking about, but it also has a fee of 40 basis points, while investing in the underlying stocks and bonds would otherwise cost 5 basis points, which I think is pretty reasonable. I would say that there's an additional 35 basis points cost of leverage. So even though the actual cost of leverage inside the fund is 37 basis points, because you're paying a higher fee, I think your actual cost of leverage as an investor is higher than the fund's cost of leverage. And that can change the results materially. Like, Scott's results are pretty sensitive to that cost of leverage. Corey made the point in the discussion also that Scott's findings depend heavily on the data generating process used. Like, Scott used this block bootstrap thing with a whole bunch of historical data. That's absolutely true. But I think Scott's final comment in this discussion kind of really captures the essence of the whole conversation, which is really whether bonds are actually good diversifying assets for long-term investors. This is a quote from Scott's post. The fact that our investors don't like bonds absolutely does depend on the fact that bonds didn't do well in our sample period, But when our sample period is all of modern history in developed countries, at some point we have to ask why we expect bonds to start giving higher returns. It's pretty good. Anyway, so the whole question is like, should you be levering up stocks and bonds to get higher expected returns instead of just investing in stocks? I don't think so. I personally don't think so. I don't think that you need a return stacking product if your intention is to increase your expected returns up to the level of an equity portfolio. I think you can just invest in stocks.
Yeah, you took the words right out of my mouth. I was about to say all that myself.
Yeah, I was just going to offer a more succinct answer to that and say no.
Probably not.
Do you guys have any other comments though? You probably do have great comments to add.
I don't know. I like the idea of it. Like you said, like on paper, it looks like, yeah, great. If I can basically get these other sources of returns stacked on top of each other at a really low cost, that intuitively makes sense, right? But when you kind of maybe peel back the layers, it's not as obvious. My son does own RSST, which is a return stacking ETF, one of Corey's ETFs. Again, my son has.
It was 6. I think that we should remind.
Actually, it's his birthday today. He's 7, so he's financially mature enough to make these decisions now at 7 years old. And if that's what he wants to do, then I'm not going to stop him, right? But no, they're cool products, and like you said, this thing's been around for a while by different names. And I think his ETFs have been very, very successful in the marketplace too, which is cool to see. And they've got like a lot of different flavors, right? Like he's got some with managed futures in there and some with just US equities and treasuries. And yeah, we'll see where they go. But I don't understand them to the degree that Ben does, so I don't have further comments on the topic.
Well, they're not that complicated. I think I do also want to say actually that they are pretty incredible pieces of financial technology. Like the fact that you can get all this leverage and some pretty interesting, to varying degrees of evidence-based sources of expected return in one product. I mean, for somebody that wants that, that's pretty cool. And I don't think they're terrible. Like in the discussion that I just had, I was going to say we had, but it's really just me talking. In the stuff I just said, like, it's not like one is clearly dominating the other. Like, it's not like the levered stock bond portfolio is massively inferior to the stock portfolio. I just think when you account for the complexity, the cost of leverage, I think there's probably some product risk in there too. I don't see the allure. I'd rather just invest in stocks, which are pretty straightforward.
I think if you're going to seek out leveraged investing, I think it's probably a great way to do it, right? Like, because a lot of people would otherwise be using like a home equity line of credit or margin, and there's a lot of potential downside risk for using those types of products. So to embed the leverage in there, I mean, it amplifies the volatility, but there's not, or maybe it doesn't, but maybe like you're not going to get margin called and lose your house or something like that, right? So if you're seeking that leverage, I think it's a cost effective and maybe safer way to do it. What do you think?
No, I like I said, they're really cool pieces of financial technology. Like for someone that wants that exposure, it's a pretty neat way to do it. And Robert Burton talked about this when he was on Rational Reminder a while ago, that if people should have leverage, it needs to be built into products, because people implementing leverage on their own is a disaster.
Yeah.
So like I don't disagree with the premise. I just wouldn't use them. And in that discussion, like the question that was asked, if a stacking is done with low risk assets, one would already have like gold market index and treasuries, can this be a good idea for an individual? I mean, the question is really asking the fundamental question that Cliff addressed in his 1996 paper, which is, are you better off levering up multiple sources of expected return that without leverage would have a lower expected return? Are you better off levering that up to the equity level of expected returns? Or are you just better off investing in equities? And I think that you're perfectly fine being just in equities.